So Finland.
Far away, you're actually better off of it.
Okay.
Thank you.
You're not going to turn that, right?
Not that you'll notice.
All right.
Thank you, Madam Chair and Board, for presenting to you tonight, which we think is a comprehensive solution, both short-term and long-term, to what we're facing. If each one of the things that we're going to discuss tonight happened on their own, we would survive and we would have no major issues. Unfortunately, the perfect storm occurred where there was issues with how we budgeted revenues, how the state presented revenues, our internal controls, how we tied out with the Board of Ed. So the first thing is, when there's a problem, you take it head on. And we are taking these issues head on. We're working with the Board of Ed, we're working with the Finance Department to come up with the solutions to the problems. We could deal with what and how they happen tomorrow. The issue before us today is a budget and affordability, and how do we sustain affordability for each of us who live in this town. So let me start by saying, to take some air out of the balloon, we're not looking at 5 or 6 or 4 or 3 mills. We are in the 2 range. But there are a series of events and things that we have to do collectively, we as a city, a tax board, alderman, Board of Ed, finance, treasurer, mayor, to survive and execute this to the point that we come out with a solid foundation and a solid fund balance. Human nature is to blame. I get it. Just let's all do each other a favor and blame tomorrow or blame in November. Right now, blame doesn't get us anywhere. Tonight we have to row together, because we have to get through this perfect storm and come out with a mill rate that's affordable, replenish fund balance, and sustain operations. So, first, on a macro level, our revenues were off. We were kind of double counting revenue from the state for some excess educational cost sharing grants, and that has gone on for 3 or 4 years. We can point to a document from the state that told us that our education block grant was $8 million, and it did not say it included the Alliance money, but it did. And that's, we can find the root document that started this. You know, I wish the answer was more complicated than that, but it comes down to be that basic. That was the revenue problem. On the expenditure side, reconciling with the Board of Ed was not happening when it should, and there were grant monies and expenditures of grant monies that were getting booked and how they were getting booked, and we've agreed to a resolution of that with the Board of Ed. That's not going to happen again in the future. We have survived the last 2 decades that I'm aware of on the backs of the homeowners. We've had very small incremental growth in our grant list for the commercial side of the house. And we've come to the end of the road. We need growth. And we need growth in the commercial side. Downtown needs to be our focus. As the state continues to cut grant money to the towns, and more is going to get cut later on, if we don't cut expenditures and we're not getting state revenue, and the revenue is not coming from commercial, only more is going to be passed to the homeowners. It's unsustainable. You know, buzzwords like regionalization, shared services, they can no longer be buzzwords. They are the reality of today and tomorrow. So I implore us as a city in the next 12 months to take serious steps to doing things that have tangible and quantifiable benefits to the balance sheet. On the expense side, yes, you go through the budget and you do it with a fine-tooth comb, and you should be commended for that. But now it starts to become the affordability and the services. Do I want to pay 2 mills each year, and will I as a resident forego some level of service, whether it be in police, fire, wherever it is in the budget? Will I forego some of that to have the ability to stay in Derby and pay the taxes in Derby? The decision's going to become tougher and tougher with each year. And you did zero-based budgeting 5 or 6 years ago. Maybe it's time to go back and start over again with that. You know, shake the tree and let's see what we can get out of it. We're in a people business, folks. We provide people to provide services to the taxpayers. So that's going to be a tough decision to make. Let me say this. The solution we're going to propose today is one that cannot be a one-night gig. We have to commit to this today, tomorrow, next year, and the following year. It's going to take us 2 years to get out of where we are today. But it's going to get us out of here with some affordable mill rate. We have a short-term plan and a long-term plan. So the first document I'd like to hand out is the 7-point recovery plan. Do you have that up here, Gene, for them? Is an 8-point plan that we've developed in collaboration with the people I mentioned on the steps we have to take, both short-term and long-term, to restore the fund balance, stabilize the mill rate, and provide for growth. The first one is debt restructuring. Each year, we issue debt for various projects, excluding the sewer, but the city projects, roads, roofs. So we have debt on the books that continues between now and the next 20 years. We've taken the approach of restructuring that debt to free up $2 million next year. Yes, we have to pay it subsequent years, but it frees it up for you to allow for affordability and fund balance replenishment. So when we go through the budget, you'll see that the debt restructuring is a 2-year benefit. Next year, a benefit of $2 million, and the subsequent year benefit of $1.5 million. Sale of assets. This is VARCA. This is starting to look at assets that are on our books that we do not need, that can generate revenue. That revenue can be directed to the fund balance this coming year, and any future sales should go to the fund balance. You try not to use that money to supplement your operating budget, because all that's going to do is fill a gap that you're eventually going to have to tax for. The third one is mill rate increases. This is actually an interesting number. The mill rate's been the same for the last 3 years. We have to have mill rate increases every year. That is the reality of where we are. There are general wage increases every year. There's cost of living increases. There's cost of inflation that we have to bear. What you will see tonight is the mill rate increase is about 6.5% if the revenues and expenditures stay as they're going to be presented. If you look at the CPI for the last 3 years, it would have equaled 6.25. But we did 0. So that's very indicative of a CPI is truly reflective of inflation and growth. If we had just done the CPI for each of the last 3 years, our mill rate increase would be about a 2.1 this year. So I found that a very interesting number. Adjust long-term cost. Here we're looking at the pension. Our pension is 86% funded. We have the ability at this point in time to reduce our annual contribution and still stay funded above 83%. We're going to reduce it by $550, move that $550 over to fund balance replenishment. That $550 will increase next year's contribution and contribution for the next 9 years by $63,000. But we need the money now. So yes, we pay for it down the road, but there's going to be growth in the pension and in the portfolio performance and wage increases. Second, number 5 is a tax sale. We are looking at a tax sale for number of taxes that are either delinquent or haven't paid. That's going to be in the budget presentation. We did them 3 years ago. They're very productive. They do generate a lot of revenue. People tend to pay when their feet are held to the fire. Structured organizational changes. This is taking the management letter from the auditor, implementing corrective actions. We're going to come back to you with tangible dates, who has the assigned action, and when it's going to be completed. If all of those corrective actions had been corrected at one point in time, we might not have been where we are today. We could have, but the chances are we might not have been. So everybody's coming to the table, and everybody agrees we have to do this to prevent a problem in the future. Grand list growth, this is key. Each and every year we have to have grand list growth. If we don't grow our grand list and we don't have commercial growth, once again it falls back on the homeowners. Number 8, we have a policy on the books right now that our fund balance is 5 to 7% of revenue. That is too low. Now, albeit a policy, we're going to be looking towards 10 or 12%, and then we're going to have the roadmap on how we're going to get there. We could adopt any number we want. Right now, we're negative. So we're going to adopt a number, and each year we're going to make a contribution in the operating budget towards fund balance replenishment. We should be committed to the sale of any asset. That revenue goes right to the fund balance. When we get to the 10 or 12%, we can take a breath and readjust the operating budget as we see fit or need. So if we go to the next slide, fund balance replenishment. How do we get there? With the restatement of the 6/30 fiscal year ending, it created a negative $2.6 million fund balance. That was a result of us, in the way we booked the revenue for 1.2 million that we double counted in revenue. It also was a restatement for some bills that were in the prior year that got pushed back, and the order restated the fund balance. That fund balance goes to negative 2.6. We anticipate a shortfall issue of 1.9 million. Once again, in the 18-19 budget, the way we budgeted educational cost sharing and the grants, the 1.2 is double booked. What that means is it's in the revenue side twice. We're only getting it once. It means we undertaxed by that same amount if our spending stays flat. So with a negative 4.5 estimate at the end of June 30th, 19, here's the roadmap we're going to use to get back to a positive fund balance. First one, you have an operating budget in 18-19 line item that says fund balance replenishment of $200,000. That's the first step towards the positive fund balance. The second one is by reducing the pension contribution from 740 to 550, keeping the pension solidly funded. We are in the top quartile in the country in public pension funding. I want no confusion about that. We are not taking this down into the 40, 50, 60% range. We're going from 87 to 85%. Still solid. The tax sale is going to generate about 1.1 million, and that's going to be this fiscal year. Capital project sweeps, we have a number of capital projects that are done. We're closing the books. We're allowed to move the cash over to the fund balance. That's a natural event, but we're highlighting here because it's going to be new money into the fund balance as of June 30th, 18. The ARCA sale, the Aldermen have authorized a sale price of $450. That sale will not occur by June 30th. It doesn't look like it's going to be signed to the point that we could count it as revenue on June 30th. So it will be a July revenue. That's why you see it in 1920. 450 is going to go to the fund balance for VARCA. The debt restructuring. By restructuring our city side debt, we're going to be able to reduce your expenditures by $2 million. But we're going to drop the money to the fund balance. That's one plan. The second plan is to keep the mill rate affordable. We may use a portion of that to supplement the taxes this year. Okay? Fund balance replenishment in the 1920 budget, you have 500,000 as a line item. That 250 went to 500, so that's a hard number. Also in 1920, there's the second, I didn't have it here, but it's in the number. The second pension payment of 550 is going to be in there as well as of July 1. So that has to be in there. Now, remember I told you debt restructuring is a 2-year hit, 2-year benefit. The next benefit is in fiscal year 2021. Okay, so it's not 1920, it's in 2021. So on July 1 of 20, July 1 of 20, this second year of the fund of the debt restructuring of 1.5 million will go to the fund balance. The assumptions here are your operating budget for 1920 is as accurate as can be on revenue, and expenditures stay within what they're approved for. So when you go in tonight with a balanced budget, if these numbers are encumbered into that, we have to watch very carefully the 1920 expenditures, and we have to watch the revenues. Anything goes askew, it only means less goes into the fund balance. So by July 1 of 20, we should have a positive fund balance of 1.8 billion in this model. If you use part of the debt restructuring for next year to supplement the mill impact, this will go down to about 750,000. But this is a solid roadmap.
What percentage is this, Keith?
Well, if you use this, we're going to be between 5 and 10, depending. If we do this, we're going to be about 7%. That's where the commitment to every year after that making an appropriation to fund balance is essential to getting to that 12% bogey. Sale of any assets going to fund balance. Essential. Containing spending gives us the affordability to move the money to fund balance. When Judy gets into the budget, we'll go over the revenue. On the expenditure, when we get to the points and the line items that these are in, we'll explain it again. That's all I have, Madam Chair.
Thank you. Does the board, now of course tonight this is a informational look at how we want to fix what's happened and how we'll look going forward. not voting on any of this tonight, we're voting on a budget, so, I would hope that we ask questions, obviously, if there's something here that concerns you, so you'll know, but we do want to go to the budget. Is there anything that really stands out here you want extra on? I think Keith's explanation was very clear. Appreciated that, without a lot of accounting detail.
Keith, this is a relatively realistic one.
Conservative, I would say. We could have thrown some extras in there that are possibilities. I guess I would say we use probability decision-making, where if something was 85% or greater reality, we put it at anything less, it would artificially present the picture.
And as I mentioned, these guys have been working on this since that night we met when we discovered that we had a hole. So, and maybe Keith could mention all the people who've been involved. It's been
A team effort,
it's
absolutely.
been a big team, yeah.
Corp counsel, John Akvali, the auditor, Doug Gillette, bond counsel, Barry Bernardi from the FA, Sal Coppola, Andrew Backlick, Mayor Zekin, Judy,